Here's a satisfying paradox for you. The safest investment in the world, government bonds, is about to trigger the most dangerous financial crisis of your lifetime. For 30 years, every financial advisor told you the same thing: diversify into bonds for safety. Every retirement planner built your future on the same foundation. And every single one of them missed what was quietly building in Tokyo. This isn't another fear-mongering headline about market crashes. This is the systematic anatomy of how a single number in Japan, 3.9%, is about to rewrite everything you thought you knew about portfolio protection. To understand why your retirement is now on a 90-day countdown, we need to start with a phone call that never should have happened. On January 20th, 2026, at 3:47 a.m. Eastern Time, a secure line connected the U.S. Federal Reserve to the Bank of Japan. What was said on that call remains classified, but what happened next was visible to anyone watching currency markets. The United States Federal Reserve intervened directly to prop up a foreign country's currency. Let that image settle in your mind for a moment. American resources being deployed not to save American banks, not to protect American jobs, but to prevent the Japanese yen from collapsing in a way that would have ricocheted back and destroyed American portfolios within days. This isn't routine cooperation between central banks. This is the financial equivalent of calling in air support because the ground troops are about to be overrun. Kenji Watanabe still remembers the exact moment he realized the system was breaking. At 62 years old, after 4 decades managing pension assets for Nippon Life Insurance, he had seen market turbulence before. The 1990 crash, the 2008 crisis, COVID. But standing in his Tokyo office that January morning, watching the 30-year Japanese government bond yield spike to 3.9% on his Bloomberg terminal, his hands began to shake. Not from fear of losing money, from the knowledge of what he would now be forced to do. Sell. Sell American treasuries. Sell American stocks. Sell everything his institution had accumulated over 3 decades. Not because he wanted to, because the math no longer worked. His firm held $47 billion in U.S. assets, and every single position was about to become a liability. Here's the number that should make your blood run cold. 3.9%. That's what Japanese 30-year government bonds are now yielding. It sounds almost comically small. It sounds like the kind of decimal point that only matters to bond traders in expensive suits. But that 3.9% is the highest yield these securities have ever seen since they were created in the 1990s. This is a move so violent, so statistically improbable, that bond mathematicians call it a 6 sigma event. Something that should occur once every 100 million years. It's happening right now. And it's accelerating. Most people get this completely wrong. They hear Japanese bonds and their eyes glaze over. They think this is some technical issue happening on the other side of the planet. Something for economists to debate at conferences while normal people go about their lives. This is exactly the blind spot that will cost unprepared investors half their wealth in the next 90 days. Because Japan isn't just any country in the global financial system. Japan is the largest foreign holder of American government debt on Earth, larger than China, larger than all of Europe combined. $1.2 trillion of your country's IOUs sit in Japanese vaults. And the people holding those IOUs just got a very compelling reason to sell. Margaret Chen, 58, spent 23 years as a fixed-income strategist at BlackRock before retiring to what she thought would be a quiet life in Connecticut. Her retirement portfolio was textbook perfect. 60% stocks, 40% bonds, Exactly what every financial advisor recommends. On paper, she had $2.3 million in retirement savings. Diversified, protected, safe. When I spoke with her last week, she was sitting at her kitchen table with a calculator, trying to figure out how much she would lose if both sides of her portfolio dropped 20% simultaneously. The number she kept arriving at made her put down her coffee cup and stare out the window for a long time. "They told me bonds were the hedge," she said quietly. "They told me that when stocks fall, bonds rise. That's the whole point. What happens when they both fall together?" What happens is something called correlation breakdown, and we'll get to exactly how that destroys traditional portfolios in Part 4. But first, you need to understand the mechanism that's about to force trillions of dollars in selling, a mechanism that most people have never heard of, even though it's been the invisible foundation of global finance for 30 years. Ask yourself this question: why would anyone borrow money in Japan at near 0% interest, convert it to dollars, and buy American Treasury bonds? The answer sounds like a magic trick. For 3 decades, Japanese interest rates were essentially zero. American Treasury bonds paid 4%, sometimes 5%. So clever investors, Japanese pension funds, insurance companies, hedge funds, discovered they could borrow yen for free, convert to dollars, buy American debt, and pocket the difference. Risk-free profit. Year after year. Hundreds of billions of dollars. This is called the carry trade, and it was the greatest free money machine in the history of finance. Marcus Webb was one of the traders who rode this wave. At 41, running a $2.8 billion fund out of Greenwich, Connecticut, he had turned the carry trade into an art form. Borrow yen at 0.1%. Convert to dollars. Buy treasuries at 4.5%. Leverage the position 15 times. Collect returns that made his investors weep with joy. For 7 years straight, his fund never had a losing quarter. "It was like finding a hole in the casino's mathematics," he told me, speaking on condition I not name his fund. "Everyone knew about it. Everyone was doing it. We just did it bigger." Last August, when the Bank of Japan surprised markets with a small rate hike, Marcus watched $340 million of his fund's value evaporate in 72 hours. That was just a preview, a tremor before the earthquake. Here's the question no one in financial media is asking. If Japanese bonds now yield 3.7%, why would any rational Japanese investor take currency risk to earn 4.8% in America? They wouldn't. And that's the death sentence for $20 trillion in leveraged positions. The number isn't a typo. Major banks estimate the total carry trade exposure, including hedge fund leverage, sits between $15 trillion and $20 trillion in notional value. These positions are now underwater. They have to be unwound. And when that unwinding accelerates, it won't just hit bond markets. It will hit everything. Sandra Okonkwo, 34, is a first-generation American who worked her way from a community college in Detroit to a senior analyst position at Citadel, one of the most sophisticated hedge funds on Earth. Her specialty is correlation modeling, predicting how different assets move in relation to each other. 2 weeks ago, her models started showing something that kept her at her desk until 3 a.m., running the numbers again and again, hoping she had made an error. She hadn't. "The correlations are breaking," she told a colleague in a message I've seen. "Everything is about to move in the same direction. Down." What most people don't realize, what even sophisticated investors miss, is that this crisis doesn't care whether you own Japanese assets or not. You own American stocks? You're exposed. You have a 401k? You're exposed. You own a home with a mortgage? You're exposed. You hold Bitcoin as a hedge? You're about to discover it's not the hedge you thought it was. In August 2024, when the carry trade briefly shuttered, Bitcoin crashed 23% in 3 days. The Nasdaq dropped 10%. The S&P 500 fell 8%. Over $2 trillion in market value vanished in 72 hours. And that was just a tremor, a small rate adjustment that surprised markets. What's coming now is different. The rate hikes are bigger. The unwind is larger. And this time, there's something else that almost nobody is talking about. Europe holds $3 trillion more in American treasuries, and Europe is about to start selling too. To understand why the next 90 days will determine whether you preserve your wealth or watch it evaporate, we need to go back 30 years, to the moment Japan made a decision that would eventually hold the entire global financial system hostage. To understand why a number in Tokyo is about to reshape your financial future, you need to understand the strange bargain Japan made with itself 30 years ago, and how that bargain quietly became the foundation upon which American wealth was built. In 1989, Japan was the future. The Tokyo Stock Exchange was the largest in the world. Japanese companies were buying Rockefeller Center, Pebble Beach, Columbia Pictures. The Nikkei index had climbed to 38,915 points, a number so astronomical that analysts predicted 100,000 by the year 2000. Japanese real estate was so valuable that the land beneath the Imperial Palace in Tokyo was theoretically worth more than all of California. Then the bubble burst. And what happened next created the financial architecture that now holds your retirement hostage. Imagine you bought a house for $1 million in 1989, and by 1992, that house was worth $400,000. Your mortgage was still $1 million. Your salary wasn't going up. You couldn't sell because you'd owe more than you'd get. So you just stopped spending. You paid down debt. You saved every yen. You waited for prices to recover. Now imagine an entire nation of 125 million people doing this simultaneously for 30 years. This is what economists call a balance sheet recession. And Japan's response to it created the most unusual monetary experiment in modern history. Hiroshi Tanaka was 31 years old when the bubble burst. A mid-level manager at Sumitomo Bank, he watched the balance sheet of his institution transform from fortress to ruin in less than 2 years. Bad loans, failed real estate projects, corporate clients unable to repay. By 1995, he had been promoted, not because of success, but because so many senior managers had been quietly let go. His job became something no banking textbook had prepared him for: managing decline. "We stopped lending to grow businesses," he told me. "We started lending just to keep zombie companies alive, because if they died, our losses would become real. As long as they survived on paper, we survived on paper." He is 66 now. The zombie companies he kept alive in 1995 are still being kept alive today. Here's what most people get wrong about Japan's situation. They think of it as a failure, a cautionary tale of what happens when a bubble pops. But from a certain angle, Japan's response was brilliantly successful. No mass unemployment, no social collapse, no political revolution. The population aged peacefully. Living standards remained high. The trade-off was simple. In exchange for stability, Japan sacrificed growth. Permanently. The mechanism that made this possible was elegant in its simplicity. The Bank of Japan pushed interest rates to zero and kept them there for 3 decades. When zero wasn't enough, they went negative. When negative wasn't enough, they invented something called yield curve control, a promise to buy unlimited quantities of government bonds to keep long-term rates artificially suppressed. Think of it like this. Imagine you're selling your house, but no buyers appear at your asking price. So your rich uncle offers to buy it himself at whatever price you want. You're not really selling to a market anymore. You're selling to someone who will pay whatever you ask because he has unlimited money and he's family. That uncle was the Bank of Japan. The house was Japanese government debt, and the price was interest rates. By 2023, the Bank of Japan owned more than half of all Japanese government bonds in existence. They had become the market. And because they could print unlimited yen to buy unlimited bonds, interest rates stayed exactly where they wanted them, near zero. Yuki Hashimoto, 45, manages fixed income strategy for the Government Pension Investment Fund, the largest pension fund on Earth, with $1.4 trillion in assets. She describes the environment she grew up in professionally as a world without interest rates. Every model she learned, every strategy she developed, every assumption she made about portfolio construction was built on one foundation. Japanese money would always be essentially free. We didn't think about rate risk, she admits now. It was like asking a fish to think about water. Now here's where this connects to your American portfolio. When money is free in Japan and expensive in America, a very obvious opportunity emerges. You can visualize it as two bathtubs connected by a pipe. One bathtub, Japan, is overflowing with cheap water. The other bathtub, America, has a drain that pays you 4% to 5% interest for every gallon you pour in. What would any rational person do? They would open the pipe. They would let Japanese water flow into the American drain, and they would collect the spread. This is the carry trade. And for 30 years, it was the closest thing to free money that global finance has ever seen. The numbers are almost absurd when you see them clearly. A Japanese insurance company could borrow 1 billion yen at 0.1% interest, essentially free. Convert those yen to dollars. Buy U.S. Treasury bonds yielding 4.5%. Collect $45 million per year in profit on a position that cost them essentially nothing to maintain. Repeat. Scale. Leverage. Why would any institution not do this? Masahiro Sato, 54, was the chief investment officer for Dai-ichi Life Insurance from 2015 to 2022. During his tenure, he oversaw the deployment of $38 billion into U.S. Treasury securities and American corporate bonds. We called it the engine, he recalls. Every quarter, we reported returns from the engine. Every year, we expanded the engine. The board loved the engine. Nobody wanted to ask what happens if the engine stops. He pauses. I knew what would happen. I just hoped I would be retired before it did. But the insurance companies and pension funds were just the beginning. Because when hedge funds saw this free money machine operating, they asked the obvious question: what happens if we add leverage? If you can make 4% risk-free by borrowing in Japan and buying in America, what happens if you leverage that position 10 times? You make 40%. What if you leverage it 20 times? 80%. What if you leverage it further and add option strategies? The returns become astronomical. Remember Marcus Webb from Part 1, the Greenwich trader who turned this into an art form? He was one of thousands. Nobody knows the exact number of leveraged carry trade positions because hedge funds don't publicly report their holdings. But estimates from Bank of America, Goldman Sachs, and J.P. Morgan converge on a range that should terrify anyone paying attention. $15 trillion to $20 trillion in notional exposure. Let me put that in perspective. That's roughly equivalent to the entire annual GDP of the United States. It's more than the total market capitalization of every company listed on the Tokyo Stock Exchange. It's a sum so large, that if it unwinds violently, there isn't enough liquidity in global markets to absorb the selling. And here's the contrarian truth that challenges everything you've been told about modern finance. This wasn't a bug in the system. It was a feature. American policymakers knew Japanese money was flowing into treasury bonds. They welcomed it. It kept U.S. borrowing costs low. It funded deficits without painful tax increases. It allowed Americans to buy homes at mortgage rates that would have been impossible without foreign demand for U.S. debt. The entire structure of American prosperity for the past 2 decades has been quietly subsidized by Japanese institutions borrowing for free and lending to America for profit. It was a beautiful machine, and like all beautiful machines, it had a single point of failure. The machine worked only as long as Japanese interest rates stayed near zero, only as long as the Bank of Japan kept buying bonds, only as long as the spread between Japanese and American rates remained wide enough to justify the currency risk. In December 2024, the Bank of Japan raised rates to 0.5%. In December 2025, they raised again to 0.75% and abandoned yield curve control entirely. They stopped being the buyer of last resort, and Japanese bond yields, freed from artificial suppression for the first time in a generation, exploded upward. Yuki Hashimoto, the pension fund manager who grew up in a world without interest rates, watched the 30-year yield cross 3% in January 2026. She had spent 20 years building models that assumed this could never happen. Now she sat in her Tokyo office, recalculating what it meant for the $47 billion in U.S. assets her fund held. The same assets that Kenji Watanabe at Nippon Life was now being forced to sell. The fish was suddenly very aware of the water. Here's the question you should be asking. Why now? Why would the Bank of Japan abandon a policy that had kept their economy stable for 30 years? The answer involves something that happened 8,000 miles away. And it explains why this crisis won't stay contained in Tokyo. The answer to why Japan abandoned 3 decades of monetary policy lies not in Tokyo, but in Washington. And when you understand what actually happened, you'll realize this crisis was not an accident, it was a choice. In October 2023, U.S. inflation had proven far more stubborn than the Federal Reserve predicted. Interest rates in America climbed to 5.5%, the highest in over 2 decades. The dollar strengthened against virtually every currency on Earth, and the Japanese yen began to collapse. Picture a chart showing the dollar-yen exchange rate. A line that had traded in a stable range for years, suddenly plunging like a stone dropped from a bridge. In 2021, $1 bought 110 yen. By October 2023, $1 bought 150 yen. By July 2024, it crossed 160. The yen had lost nearly a third of its value against the dollar in 3 years. For ordinary Japanese citizens, this was catastrophic. Japan imports almost all of its energy, most of its food, and a significant portion of its manufactured goods. A weaker yen meant higher prices for everything. Inflation in Japan, a country that had experienced almost none for 30 years, suddenly spiked to levels that made households panic. The cost of imported beef doubled. Electricity bills soared. The price of a simple bowl of ramen in Tokyo increased by 40%. Keiko Yamamoto, 67, had retired from her job as a nurse in Osaka with what she believed was a comfortable pension. She had done the math carefully. Her savings, plus her government pension, would allow her to live modestly but peacefully for the rest of her life. Then, the yen collapsed. "I watched my purchasing power disappear," she told a Japanese newspaper in November 2024. "The numbers in my bank account stayed the same, But what those numbers could buy got smaller every month. I started eating one meal a day. Not because I couldn't afford two, because I was afraid of what tomorrow would cost. Multiply Keiko's story by millions. That's what forced the Bank of Japan's hand. Here's what most people get wrong about the Bank of Japan's decision to raise rates. The financial media presented it as a confident policy choice, a sign that Japan's economy had finally healed enough to normalize. Central bankers gave measured speeches about achieving sustainable inflation targets and entering a new phase of monetary policy. The official story was progress, recovery, success. The reality was surrender. The Bank of Japan did not raise rates because they wanted to. They raised rates because they had no choice. The yen was collapsing. Their population was suffering. And the alternative, continuing to suppress rates while the currency fell further, would have triggered a political crisis that no amount of monetary policy could contain. But here's the twist that should make you sit forward in your chair. The very act of saving the yen guaranteed the destruction of the carry trade. And the people who designed this system knew it would eventually happen. They just assumed it wouldn't happen on their watch. Remember Masahiro Sato, the Dai-ichi Life executive, who called the carry trade the engine and hoped he'd be retired before it stopped? He was not unique. Across Japanese institutions, across American hedge funds, across the entire global financial system, professionals built careers on a trade they knew was mathematically unsustainable. They collected bonuses. They earned promotions. They managed billions. And they passed the risk to the next generation like a game of musical chairs, knowing that when the music stopped, someone else would be left standing. The music stopped in December 2025, when the Bank of Japan raised rates to 0.75% and abandoned yield curve control. They didn't just adjust monetary policy. They detonated the foundation of 30 years of global financial architecture. The 10-year Japanese government bond yield, which had been artificially held below 0.5% for years, shot past 2% within weeks. The 30-year yield hit 3.9%, and the math that had made the carry trade free money suddenly made it a death trap. Let me show you what this looks like in human terms. Marcus Webb, the Greenwich hedge fund manager from Part 1, had rebuilt his positions after the August 2024 tremor. His fund had recovered. His investors had stayed. His confidence had returned. On January 21, 2026, the morning after Japan's bond yield spiked, he arrived at his office at 5:30 a.m. to find 17 margin calls waiting. His prime broker wanted $890 million in additional collateral by end of day. He didn't have it. Nobody has that kind of liquidity sitting idle. By 4 p.m., his fund had liquidated 60% of its positions, not because he wanted to sell, but because his creditors forced him to sell. "We dumped everything that had a bid," he told me later. Apple, Microsoft, Treasury bonds, Bitcoin. We weren't making investment decisions. We were making survival decisions. But Marcus Webb had options. He could close his fund and walk away wealthy. He could take a job at another firm. He could recover. Now let me tell you about someone who can't recover. David and Patricia Holloway are both 64 years old. They live in suburban Phoenix. David worked for 38 years as an operations manager at a manufacturing company. Patricia was a school administrator. Together, they saved $1.8 million for retirement, invested exactly as their financial advisor recommended. 60% stocks, 40% bonds. Safe, diversified, protected. Pause for a moment and consider something. The Holloways did everything right. They didn't speculate. They didn't chase meme stocks or crypto moonshots. They trusted the system. They followed the rules. And that system is about to fail them in a way their financial advisor never warned them about. Because when the carry trade unwinds, it doesn't discriminate. Hedge funds selling to meet margin calls dump the same stocks that sit in the Holloway's retirement account. When Japanese institutions liquidate treasury holdings, the same bonds that were supposed to protect the Holloways fall in value alongside their stocks. The correlation breakdown that Ken Griffin warned about, stocks and bonds falling together, means their diversified portfolio is actually 100% exposed to the same risk. Here's a question that should make you angry. Why do Marcus Webb and the hedge fund traders get advance warning, while David and Patricia Holloway have no idea what's coming? The answer is the rage moment you need to understand. In September 2024, 4 months before the Bank of Japan abandoned yield curve control, Goldman Sachs quietly reduced its Japanese bond exposure by $12 billion. In October, JP Morgan shifted client portfolios away from yen-denominated assets. In November, Citadel, Ken Griffin's fund, began building short positions in Japanese government bonds. By December, every major hedge fund and investment bank had repositioned. They knew. They could see the math. They had access to Bank of Japan officials, to Treasury Department contacts, to the kind of intelligence that never appears in any newspaper. When the January spike hit, they weren't victims. They were prepared. Some of them profited enormously. Meanwhile, David Holloway was watching football. Patricia was planning their granddaughter's birthday party. Their financial advisors sent them a holiday card in December with a message about staying the course and long-term thinking. Nobody told them that the foundation of their retirement was about to crack. Nobody mentioned that the same institutions managing their money were quietly exiting positions. Nobody explained that diversification doesn't work when the entire system breaks at once. This is not a market functioning as intended. This is a wealth transfer from people who follow the rules to people who make the rules. Yuki Hashimoto, the Japanese pension fund manager who realized she was a fish becoming aware of water, told me something in our conversation that I haven't stopped thinking about. The system worked, she said. For 30 years, it transferred wealth from future generations to present generations, from ordinary savers to sophisticated traders, from people who trusted institutions to people who controlled institutions. And now the bill is coming due. But the people who built this system will not be the ones who pay. And here's the second twist that the financial media refuses to discuss. This is just the first wave. Remember the $1.2 trillion in Japanese treasury holdings? That's significant. But Europe holds $3 trillion more. And Europe is broke. European governments are facing enormous pressure to increase defense spending, 3% to 4% of GDP, because of the war in Ukraine and demands from Washington. They don't have the money. Their economies are stagnant, their populations are aging, and their most liquid asset, the easiest thing to sell quickly, is American Treasury bonds. If Japan's $1.2 trillion in selling pressure is enough to spike U.S. yields and trigger correlation breakdown, what happens when Europe adds another $500 billion? Another trillion? The scale of what's coming makes August 2024 look like a minor correction. In those 72 hours, Bitcoin crashed 23%, the Nasdaq dropped 10%, and $2 trillion in market value evaporated. All from a small, unexpected rate adjustment. What's happening now is larger, more telegraphed to those with access, and completely invisible to ordinary investors checking their 401k balance on a phone app. But here's what should truly terrify you. We haven't even discussed what happens when the Federal Reserve is forced to choose between two catastrophic options. The Treasury Secretary's response at Davos, hoping that Japan would say things to calm markets, revealed something important. The adults in the room have no plan. They have hope. They have phone calls. They have the ability to intervene temporarily in currency markets, as they did in January. But they cannot stop the underlying math. They cannot make the carry trade profitable again. They cannot force Japanese institutions to keep holding American debt that no longer makes financial sense. And when hope runs out, when words stop calming markets, the Federal Reserve will face a choice that will determine whether your portfolio survives the next 90 days. That choice, and why both options are catastrophic for ordinary investors, is where this crisis transforms from financial news into economic history. The cruelest part of what's coming isn't the crash, it's the slow bleed that follows. We've been conditioned by Hollywood and financial media to imagine economic crises as dramatic events. A single day when markets collapse, banks close, people line up for bread. The reality is far more insidious. Modern financial crises don't kill quickly, they kill slowly. They hollow out wealth over years and decades so gradually that most people don't realize what's happening until it's too late to change course. To understand what the next 10 years will look like for American portfolios, we need to examine what happened in a country that already lived through a version of this crisis. Not Japan's slow decline, but something faster, more violent, and more instructive. In September 2022, the United Kingdom elected Liz Truss as Prime Minister. Her government announced a budget that markets didn't believe: tax cuts without spending reductions, borrowing without credibility. Within 72 hours, British government bonds collapsed. The pound fell to its lowest level against the dollar in history. And something happened that most people have already forgotten. British pension funds nearly went bankrupt. Picture a chart showing the yield on 30-year UK government bonds. A line that looks like a heartbeat monitor during cardiac arrest, spiking violently upward as prices collapsed. Pension funds that had used these bonds as collateral suddenly faced margin calls they couldn't meet. The Bank of England had to intervene with emergency bond purchases to prevent the entire system from seizing. Truss was removed from office after 45 days. But here's what nobody tells you about what happened next. Margaret Whitfield was 61 years old in September 2022, a retired teacher living in Manchester with a pension she had contributed to for 35 years. On paper, her retirement was secure. Guaranteed income from her defined benefit plan, a small portfolio of savings, a paid-off home. She didn't trade bonds. She didn't understand yield curves. She thought she was safe. 2 years later, her pension fund announced it was reducing benefits by 15% due to losses incurred during the gilt crisis. Her local council raised property taxes to cover municipal pension shortfalls. The value of her home, which she had planned to sell to fund her later years, dropped 12% as mortgage rates doubled. By 2024, Margaret's effective retirement income had declined by nearly 30%. Not through any decision she made, but through decisions made by traders in London and policymakers in Westminster. Now let me show you the other side of that same crisis. Sebastian Price was 38 in September 2022, a portfolio manager at a London hedge fund specializing in fixed income arbitrage. When Truss announced her budget, Sebastian's models immediately flagged the gilt market as mispriced. Within hours, his fund had built a massive short position against UK government bonds. Over the next 3 weeks, as pension funds were forced to liquidate and the Bank of England scrambled to restore order, Sebastian's fund generated $340 million in profit. His personal bonus that year was $12 million. He bought a home in the Cotswolds with cash. Same crisis, same 3 weeks. One person's retirement was permanently diminished. Another person bought a country estate. This is not a market functioning as designed. This is a wealth transfer mechanism operating exactly as the people who built it intended. What most people get wrong about the coming decade is that they imagine recovery. They assume this crisis will be like 2008, painful but temporary, followed by a long bull market that makes everyone whole again. They believe the Federal Reserve will intervene, print money, support markets, and restore normalcy. Here's the contrarian truth. The tools that worked in 2008 and 2020 will make this crisis worse. When the Fed printed trillions to save markets in 2020, inflation was dormant. They could create money without immediate consequences. That's no longer true. Inflation is sticky, embedded in the economy, and any return to massive money printing will spike prices further. The Fed faces an impossible choice: let markets crash to control inflation, or save markets and let inflation destroy purchasing power. Both options devastate ordinary investors. Neither option affects the wealthy. Let me show you what the next decade looks like for two families making different choices today. David and Patricia Holloway, the Phoenix couple from Part 3, with their $1.8 million retirement portfolio, will wake up on January 1st, 2027, to discover their portfolio has declined to $1.3 million. Not catastrophic, they'll tell themselves. Markets fluctuate. We'll wait it out. By 2029, after 2 more years of elevated interest rates, correlation breakdowns, and continued foreign selling of treasury bonds, their portfolio will sit at $1.1 million. Their financial advisor will tell them to stay the course. Long-term thinking. Don't panic. By 2034, when David is 72 and Patricia is 71, their portfolio will have partially recovered to $1.4 million, still below where they started. But inflation will have increased their cost of living by 35%. Their effective wealth, measured in what they can actually buy, will have declined by nearly half. They will sell their home and move to a smaller apartment. They will not travel. They will not help their grandchildren with college. They will spend their final years in quiet, dignified decline, wondering what they did wrong, never understanding that they did nothing wrong. They simply trusted a system designed to fail them. Now contrast this with someone who understood what was happening. Sandra Okonkwo, the Citadel analyst from Part 1, whose correlation models showed her what was coming, will make different choices. In February 2026, she will quietly shift her personal portfolio away from the traditional 60-40 allocation that everyone recommends. She will move 30% into short-term treasury bills, avoiding the duration risk that destroys long-term bonds. She will allocate 25% to commodity producers and energy companies, sectors that benefit from inflation and maintain pricing power. She will put 15% into physical gold and gold mining stocks. She will keep 20% in quality technology companies with fortress balance sheets. And she will maintain 10% in Bitcoin, not as speculation, but as an uncorrelated asset outside the traditional system. By 2034, Sandra's portfolio will have grown from $800,000 to $1.9 million. Not because she got lucky, but because she understood the mechanism. While the Holloways watched their wealth erode, Sandra watched hers compound. The same decade, the same economy, radically different outcomes determined by access to information that one family had and the other didn't. Here's the question that should haunt you. Why did Sandra know what was coming when David and Patricia didn't? The answer is the great unspoken truth of modern finance. Information flows downhill, slowly. By the time warnings reach ordinary investors through mainstream media and financial advisors, sophisticated money has already repositioned. The August 2024 crash that we discussed in Part 1 was visible to hedge funds weeks before it happened. They were prepared. Retail investors checking their phone apps were blindsided. But here's an unexpected twist that offers a sliver of hope. The mechanism that creates this inequality is the same mechanism that allows you to protect yourself if you understand it in time. Remember Kenji Watanabe, the 62-year-old pension fund manager from Part 1, whose hands shook when he saw the 30-year yield hit 3.9%? He's being forced to sell American assets. He has no choice. But the process of unwinding $47 billion takes months, not days. The selling pressure is predictable. The timeline is visible. Unlike a sudden crash that gives no warning, this crisis is unfolding in slow motion, which means there is still time to act. The next 90 days represent a window, not a large window, and it's closing, but a window nonetheless. Imagine a timeline stretching from today to April 2026, 3 critical months that will determine whether you spend the next decade like the Holloways or like Sandra. The signals are clear if you know where to look. The 10-year Treasury yield above 4.75% is a warning. Above 5% is a crisis. The dollar-yen exchange rate dropping below 140 means the unwind is accelerating. Bank of Japan policy meetings in March will telegraph the next wave of rate decisions. Most people will do nothing. They'll read articles about market turbulence and assume it doesn't apply to them. They'll trust their financial advisors, who are still recommending the same allocations they recommended in 2019. They'll wait for clear signals that never come clearly until it's too late. And in 2034, they'll wonder what happened. But you're not most people. You've watched for nearly an hour. You understand the carry trade mechanism. You know why Japanese institutions must sell. You've seen how correlation breakdown destroys traditional portfolios. You have information that David and Patricia Holloway don't have. The only question remaining is what you're going to do with it. Because knowing this information means nothing if you don't act. And the specific actions that protect wealth in this environment, what to buy, what to sell, what to watch, and when to move, require understanding one final piece of the puzzle. What happens when the Federal Reserve is forced to choose between saving the bond market and saving the dollar? That choice is coming faster than anyone in Washington wants to admit. And the answer will determine everything. Let me bring you back to where we started. It's January 2026. A secure phone line connects Washington to Tokyo. The Federal Reserve intervenes to support a foreign currency. And somewhere in suburban Phoenix, David Holloway is watching football, completely unaware that the retirement he spent 38 years building is about to be restructured without his consent. We've spent nearly an hour together examining the mechanism behind what's happening. The 30-year carry trade, the $20 trillion in leveraged positions, the correlation breakdown that transforms diversified portfolios into concentrated risk, the impossible choice facing the Federal Reserve. None of this is conspiracy. None of this is prediction. This is simply how the system was designed, operating exactly as intended, producing exactly the outcomes it was built to produce. But before we part ways, I want to revisit the people whose stories have guided us through this analysis. Because understanding mechanisms is important, but understanding what those mechanisms do to human lives is essential. Kenji Watanabe, the 62-year-old pension fund manager, whose hands shook when he saw the 30-year yield spike, made a decision in the weeks following January 20th. He could have delayed. He could have hoped for yields to fall back. Instead, he began the orderly liquidation of his fund's American holdings. $47 billion unwound over 6 months rather than 6 days. It wasn't heroic. It was mathematical. But in making that choice, he protected the retirements of 2.3 million Japanese pensioners who will never know his name. Someone has to absorb the loss, he told me in our final conversation. I decided it wouldn't be the people who trusted us with their futures. Picture him standing at his office window in Tokyo, watching the sun set over a city that has endured collapse before, knowing that the system he spent his career serving had finally reached its limit. Margaret Chen, the retired BlackRock strategist in Connecticut with her textbook 60/40 portfolio, did something unexpected. After our conversation about correlation breakdown, she spent 3 weeks studying the mechanism herself. Not to become a trader, not to time the market, simply to understand. In February 2026, she restructured her portfolio. Not dramatically, not recklessly, but thoughtfully. She reduced duration risk. She added commodity exposure. She accepted that the rules she had learned over 23 years at BlackRock no longer applied to the world she was living in. "I'm not trying to get rich," she told me. "I'm trying to not get poor. There's a difference." And Marcus Webb, the Greenwich hedge fund manager who watched $340 million evaporate in August 2024 and then rebuilt, only to face 17 margin calls on January 21st. His fund survived. Barely. He liquidated 60% of positions, took massive losses, and spent the following months explaining to investors why their returns had evaporated. But here's the twist you might not expect. Marcus is done. Not bankrupt, he's still wealthy by any normal standard. But done with the game. "I spent 15 years exploiting a mechanism I knew was broken," he admitted to me. "I told myself I was just playing by the rules. But I helped build a system that was always going to hurt regular people when it unwound. I don't want to do that anymore." He's starting a financial literacy nonprofit. Whether that's redemption or penance, I'll leave for you to decide. What pattern emerges when you look at all these stories together? The people who understood the mechanism, whether they profited from it or simply protected themselves, had one thing in common. They didn't wait for permission. They didn't trust that institutions would protect them. They took responsibility for understanding how the system actually worked, not how it was supposed to work. And they made decisions based on that understanding. This brings me to something important. I've deliberately avoided telling you what to do with your money. That's not my role, and anyone who claims to know exactly how this crisis will unfold is either lying or deluded. Markets are complex. Timing is impossible. Predictions are performances. But I can offer you a framework, not for making money, but for thinking clearly when everyone around you is either panicking or pretending nothing is wrong. 3 questions to ask yourself. First, do I understand where my money actually is and what assumptions my portfolio is built on? Most people couldn't answer this question honestly. Their retirement sits in target date funds chosen by default, built on correlation assumptions that may no longer hold. Second, if both my stocks and bonds declined 25% simultaneously, what would my life look like in 5 years? This isn't fear-mongering. This is the scenario that correlation breakdown produces. If you've never visualized it, you're not prepared for it. Third, am I making decisions based on how I wish the world worked or how it actually works? The carry trade worked for 30 years. The 60/40 portfolio worked for 40 years. Past performance, as the disclaimer says, does not guarantee future results. Systems change, mechanisms break. The question is whether you change with them. I want to be clear about something before we close. This video was never about telling you the world is ending or that you should panic. Markets have survived worse. Economies have recovered from deeper wounds. Japan itself endured the collapse of the greatest asset bubble in history and emerged with one of the highest living standards on Earth, even if growth never returned. The goal was simpler: to show you the mechanism, to reveal what's actually happening beneath the headlines about bond yields and currency interventions, to give you the same information that hedge funds and institutional investors already have, so that whatever decisions you make them with open eyes. Remember Yuki Hashimoto, the Japanese pension fund manager who described herself as a fish becoming aware of water? That awareness didn't save her from the crisis. It didn't make the losses disappear, but it allowed her to act with intention rather than confusion. It allowed her to protect what could be protected and accept what couldn't be changed. That's not nothing. In a world where most people are swept along by forces they don't understand, simply understanding is a form of power. The Federal Reserve will make its choice in the coming months. They'll either let markets fall to preserve the dollar's purchasing power, or they'll print money to save markets and let inflation accelerate. Both paths lead to wealth destruction for unprepared investors. Both paths create opportunities for those who see clearly. The mechanism doesn't care about fairness. It only cares about math. Hope is not a strategy. Math always wins. And here's the final truth that took me years to understand. The signature of everything we've discussed. Financial crises don't destroy wealth. They reveal where wealth was never real to begin with, and transfer the rest to those who understood the mechanism before it broke. The $20 trillion carry trade unwind isn't the crisis. It's the revelation. What it reveals about your portfolio is still being written, and you have exactly 90 days to decide whether you're reading that story or writing it.